Hello, this is Dr. Paul Cottrell, and I'm going to be talking about the financial markets, uh, dealing with primarily the U.S. markets. Okay, so what we have, I'm going to go over the SPY, which is the S&P 500 index. So we have here on this screen here, you can see my cursor or finger here. This was the high point right before we started having the crash. Okay, and then we started doing the crash, and then we started having somewhat of a mean reversion. Okay, this line here is the 50-day moving average, and there is this line here that's the 200-day moving average. Each candle is a day. Okay, and the height of the candle is the spread, the range of prices throughout the day. So we peaked at 339 on SPY ETF, and then we started having the big fall, and then we bottomed at 218. Okay. Now, when you put a fib sequence retracement from the high to low, it will there are retracement lines. There's a 23% retracement line, a 38% retracement line, a 50% retracement line, a 61% retracement line, and then a 78% retracement line. So this is the kind of the golden ratio that a lot of traders use, a lot of algorithms use. So you'll notice that when you do that, that we had a bounce off of the 38% retracement that bounced down and then bounced back off of the 23% retracement. Okay, so the dynamics here are following the fib sequence. So the next big resistance point is the 50%. And that 50% retracement lasted for we can see that it bounced off the 50 and then was hugging it for a little while. So it was hugging the 50-day, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days. Okay? And the 200-day in the 50 is still below the 200-day. And we just surpassed the 50-day moving average and are right at the 61% retracement. So that is a strong indication that we're going to have some resistance. And then if we have some good news in the market, now good news in the market might be Federal Reserve is going to buy more assets, because you got to remember, most of the economy is shut down. So the economy here is not because it's real. It's people that had cash, institutional investors, or asset purchases from the Federal Reserve that's supporting this market. Okay? That's why I said that if you're an average investor for your retirement or whatever, just stay out of the market. Don't go in. This is a professional market, only for institutional investors. So I'm going to give some insight for institutional investors, and I'm going to give insight for regular investors. Regular investors, stay out of the market. Don't put money into the market. Wait until October to see if there's a second wave. Okay? Because if there is a second wave and we have to go back into shelter in place and there's more layoffs, then you're gonna lose money. So it's better to keep your cash on hand. For institutional investors, you have to follow an IPS, an investment policy statement, and show return, for your portfolio. So your constraints are different. For institutional investors, putting a little bit in the market right now is wise, but not for regular investors. Regular investors stay out of the market. Don't be a hero. You'll get fucking killed. All right? Institutional investors, they have different parameters. Again, if you're a regular investor, stay out of the market. But if you're an institutional investor, what's going to happen is you're going to see a bounce off of the 61.8% retracement. It's going to go down a little bit. This is the time where it would to deploy some cash into an ETF, like the S&P 500 or maybe the Russell 2500, or it might be wise to do. Now, some portfolios, they may not be trading ETFs. They may be trading individual stocks. I'm more of a macro trader, either in the commodities market or the ETF market. So I'm not a big fan of picking individual stocks. I think there's too much idiosyncratic risk. So, but there's some big news coming out with Gilead. They are getting better with their clinical trials. So it may actually, for institutional investors, not average investors, because of the idiosyncratic risk of Gilead, it might be beneficial for institutional investors to start putting a little bit of money into Gilead. All right? This is the remdesivir therapeutic. So it might be wise to do that. I also think that deploying some cash in Amazon, Apple, and maybe even Netflix. Some plays that have been hurt by the, you could start deploying cash in tech companies that were hurt by this, consumer market. That's Apple. So Apple would be a good play for deploy some cash for your portfolio. For institutional investors, not regular investors. Regular investors are going to get killed. And Amazon, because I think that Amazon is going to be a big winner in this whole game here, long term, especially over the 4-year mark. But Netflix, Amazon, obviously, because of people are going to be buying stuff online. People are going to be watching a lot of they're not going to want to go out when we start going back to work. They're going to be. It'll have the same dynamics as what happened right after 9/11. People stayed indoors, so you're going to have a lot of germaphobes out there. They're going to just stay indoors, even though they can go out. So there's still going to be a lot of people watching TV. So there's going to probably be an uptick in subscriptions once people are going back to work and they have funds to pay for subscriptions, monthly subscriptions. So a subscription model that is entertainment related, I think it may be a wise investment in portfolios. I would stay away from airlines. I have never been a fan of airlines. They go bankrupt too much. There's way too much idiosyncratic risk, and I'd stay away from the airlines. Defense stocks. I'm talking about military defense stocks. We're going to start hearing rumblings of war with China. It may be prudent to start putting money in to Lockheed Martin and those types of companies that are tied into the military industrial complex. Northrop Grumman, those types. In terms of oil, there's going to be some big mergers, I think, that are going to be happening. There's going to be a lot of people that are struggling and they're going to look for some sort of way out. So there's going to be consolidation. So look for potential M&A activity in that. And for institutional investors, in the long haul, I think you'll benefit from that M&A activity. Now, but there's going to be a little bit of a bounce. We're right at the 61% retracement. So there's going to be a little bit of bounce. We're going to hear some news from the Federal Reserve. They're going to be stimulating, so the market is going to rally from that. All right? But that's not a good thing, because all this movement is predicated on, one, we don't have a second wave in October, and this is all Fed money or institutional money that had cash on hand. All right? This is not real economy. The real economy is being destroyed. All right? So let's keep that in mind, that real economy sucks. There is a 61% retracement from the low in the financial market, but that's Federal Reserve funny money. All right? So Fed's going to start pushing for this liquidity. They're going to help with the market here. Now, if you look at the 10-year bond, it's at a very, very low yield. It's at 0.6. I don't feel comfortable until it's at 1.24. So we got a long ways to go. We have almost double. We have to double the yield. Now I could jump to 0.8 or 0.9 pretty quickly. All right, and as the market, as we see people going back to work, we should see those yields going up on the bond market. So that would mean that if you have positions in the 10-year bond recently, you'll maybe lose some money on that. So be careful that we're near the bottoming of, I think, the 10-year bond, but it may go down to 0.5, all right, or 0.45 on the 10-year. The Federal Reserve is probably going to start moving towards that negative interest rate, right? And maybe it's sustained, maybe it only happens for a few days. The canary in the coal mine was what was going on in the oil market. So oil futures, we are pretty low. We're at about $16 a barrel, $17 a barrel, if I remember right. So if we look at, I think it was the June contract. Yeah, the June contract, we're trading at 16. All right, that's pretty damn low. USO, which is a very large ETF, we have restructuring of that ETF, so it jumped. So it was trading like $2 or something like that. Usually it trades at like 11, 12, 10, bounce around between 10 to 13, something like that in normal times. But the trading now is, I think, at 17. So USO, most people won't buy the oil futures. They'll buy into the USO. So it was trading at 2. It was restructured, and now it's trading at 18. Right. So this is a reverse split. Something happened to Gush multiple times during this crisis, and Gush is a leveraged ETF. It was at 3 times, now it's at 2 times. But the USO is now trading at 18, but that jumped from 2 to 18, but that's because of reverse splitting. So we still have suppressed oil prices. So if you're a long-term investor for institutional and you need to deploy some money in the commodities market, it may make sense to start doing that in the oil market. All right. Now, most of these individuals would probably, most of these portfolio managers would probably move towards suppressed oil companies and, you know, that have real assets instead of just trading the commodities market. But if you have some money to deploy into the commodity market, it would make sense to maybe put it into oil now with USO potentially. Now, if we go to the currency market, I'm always looking at the U.S. yen trade, and it's trading at 106. Now it bounced to 109 and then dropped back down to 106, and it's hugging its 200 day, I think it is. Well, what we have right now is we have the 50-day crossed over. The 50-day crossed over the 200-day moving average, so there's a little bit of a sell-off. So it went from 109 to 106. So it's not that bad. I'd prefer it to be above 109. But as the yen strengthens, that shows risk in the market. And right now, it's at least currency-wise, the yen is a little bit appreciated versus the USD than I'd like. I'd like to see, 108, 109, 110 higher. That'd be great. Now, if you look at the VIX, VIX is the risk, kind of like an index on dealing with risk. Right? The higher the number, the more risk there is, and more volatility there is in the market. Okay, so when we started this crisis, all right, the VIX was starting to trade really high, and I was telling you that Lehman was in the 80s, right, and we peaked at 85.47. Okay, so we've had a very, very bad volatility, and everyone has seen it. We saw the fall of the price in the S&P 500. What is nice, though, is since that peak, which happened at around 318, it's been steadily going down, okay? Now we're trading at about 31. It's still elevated. We prefer 15. 15 is like, good times, all right? Or 22. But compared to 85, 31 is good. And we are seeing that stock market go up and the volatility go down. That's good. But we still haven't seen people going back to work and how people will spend, because there's a lot of people that have been laid off, and it's going to take people to catch up on that lost revenue. So things aren't just going to just reboot right away. It's going to take months, it may take years to fully recover. We don't know, because we don't know the dynamics of this virus long term, meaning the next 18 months. All right. So short term, meaning the next month or so, we should see a market going up, assuming that the Federal Reserve continues with its assets purchases and adds liquidity in the market, but that's going to suppress bond yields and move us towards a negative interest rate, which we really don't want to go down that road. This is the government supporting the market right now. All right, the Federal Reserve supporting the market. The institutional investors that had cash on hand supporting the market. This is not the real economy, right? So it's important to make that distinction. But if we don't have a October event with this virus, meaning a tick up in infections, which a lot of experts are saying we probably will have. If we don't, then the VIX will continue to go down and the market will continue to go up, and then that's the time for regular investors to start going into the market. All right, but until we know for sure that we don't have that event in late October, regular investors need to stay out, because this VIX, if that event happens, will start to spike up again. It probably will not hit the 85. It probably will, if we had another event, it would probably peak at about 65, 70 on the VIX. But you still have a major sell-off. Now, that's why I keep on saying wait. It's like an insurance policy. It's better to be safe with cash than to be in the market for the average investor. But the ones that are managing portfolios professionally, they have special fiduciary responsibility, and they are governed by an IPS, and they have certain constraints. So that's a totally different game. Now, those ones that think that they're going to be a hero by taking this advice that I am and saying, that I'll try to trade like a professional investor, you might get hurt. You might get hurt, and it's your own damn fault for not taking my advice. Because if you're a retail trader, stay out of the market, because you're not good enough. You're not good enough to understand what's going on, because we're dealing with a lot of unknown here. All right? This is not like Lehman, where it was a financial crash. It was a financial engineering that caused the crash. This is biological engineering that caused the crash. And the virus doesn't give a damn about the Federal Reserve. All right? So stop, I don't want regular investors getting into the market. I think you have a high chance of getting hurt if we have a second wave. That's why I said, this is a big part of what I'm saying is really for the institutional investors. But that's my take on it, that there isn't that much risk in the currency market at the moment. There is suppressed 10-year bond yields. I'd like to see it at 1.2 or 1.3 for the 10-year, but we are at 0.6, so we're half of where I'd like it to be. It's going to take a while to get there, and it could go down more, maybe as far as 0.45 on the 10-year. And if that happens, then you're talking about negative interest rates on the front end of the curve, which is very possible. We'll have to see what happens with the Federal Reserve. I think their announcement's tomorrow. Now, we're hearing a lot of individual companies coming in with very negative forward guidance because of their unknown. I think that when we start to get out of shelter in place, people aren't going to spend as much. They may go to restaurants, but they're not going to be like buying homes and cars and all that stuff, big durable goods for a while. And not everybody's going to be going back to work, because what's going to happen is these companies are going to use this as an opportunity to get rid of the deadwood in the organization. So you may have 10%, maybe 20% of your workforce at your larger company. This may not be true for smaller companies, but with the larger company, not everyone's going back to work. There's going to be a certain percentage that doesn't go back to work, and they're just going to say, they're going to keep them laid off, and it may be affecting older workers. They may play this age game, because they cost more and they're older, which I think is wrong. I think they should be bringing them back, but these companies are not going to be bringing everybody back. Some companies will, depending on the size, but you got to remember that cash flows are really bad for these businesses. So they can't support bringing everyone back at the same time. And you keep on hearing in the news that there's going to be a new normal, it's going to take a while to get back to the economy that we remember before Wuhan. But we can do it. It's going to take some time. And we just have to do it step by step. So that's my market analysis right now. And things are healing, but things could get worse in October. And I want you to be careful and keep cash on hand, because you don't know if you're going to be called back to work. if you've been laid off or furloughed, right? You just don't know. And you don't know what's going to happen in October. And it's better to have cash and not have your money get eroded by another fall in the market, just in case you need it. That's why I keep on saying that for the regular investor, stay out of the market. Don't chase it. The professionals out there, you know, they have to be in the market. That's their game. They have to do that. So, and the professionals, if we have another leg down in October, you're going to see a lot of redemptions. So you have to keep that in mind, that you're going to have cash on hand so you can absorb those redemptions. Because if people are not going back to work, they're going to start liquidating. If they're permanently laid off, they're going to start liquidating their 401k. Their 401k and mutual funds, their IRAs, to be able to float their expenses. And that's going to be another leg down in the market. So that's my perspective on this. We're not out of the woods. Things are healing. The VIX is a lot lower than it was at the peak. At 85 was the peak. Now we're in the 30s. So that's a good sign. But this is because of Federal Reserve. This is not because of the real economy. We had a negative 4.8% annualized GDP. That is really bad. All right? But if we can get back to work soon, then the healing process will continue. So that's my take on this. Take it for, try to digest what I'm saying, and hopefully it helps your personal finances. But don't chase the market. Don't chase the market. It's not worth it. It's not worth it. It is not worth it, because you don't know what's going to happen in October. Because that is a big unknown. So thank you for listening to this market analysis special report for the coronavirus war room. Thank you for listening, and have a nice day.